Hello friends, probably everyone has already noticed that the stock market is always at maximum levels and continues to grow. The dividend yield on the S&P 500 index reached 1.3% per annum, which is the same level as it was in the period of 2000, when the dot-com crisis occurred. Many savvy investors have already stopped investing in the stock market to preserve their assets. So what should these investors do if they sold their stocks while waiting for the prices of their favorite stocks to fall, and they continue to surprise with new peaks? I have found an alternative for the next few years that I believe can give me a return at least as good as the average return of the S&P 500 index, despite the fact that there is almost no risk. I know that sounds a little weird, but it's true, and that's the index I'm currently buying. BND is a general bond market diversified with bonds with maturities ranging from 1 to over 25 years. So let's get into why I buy this index. Right now I have almost 93% of my total portfolio in this index, and if you've watched the videos on my channel, you probably already know that I love diversification, and even such large companies like Coca-Cola would not take up more than 3% of the total portfolio in my portfolio, and this only shows that I am almost 100% confident in this index fund. The first and foremost reason to buy this index is its safety. Bonds are one of the safest assets to buy, because the US simply has no choice but to repay the debt they have taken on, because if they can't their credit ratings will drop and they won't be able to take on more new debt, otherwise they would have to borrow at crazy interest rates, so this asset is one of the safest. In addition, this index has more than 11,000 bonds in its portfolio, which means that even if a couple of them default, it will have little effect on the index, which again increases the reliability of this index. The second reason is that the index pays monthly dividends. Like any company, the index distributes dividends to its investors. Currently, this yield is at the level of 3.62% annually, which is quite a good alternative. For example, Coca-Cola currently pays around 3.1% annually, which represents 73% of its net profit. If it were to pay out 100%, the dividend yield would be 3.94% annually. Therefore, the difference of 0.32% annually is significant. If you calculate it without skipping details, it amounts to a 10% difference in dividend strategy. Viewing it from this perspective, the difference is substantial, but the best is yet to come. The third reason I buy this index is the potential for its price to rise in the next few years to $83 to $85 per share, representing a potential upside of 15%. The price of this index is directly influenced by the Federal Reserve's interest rates, moving inversely. If the Fed raises rates, the index's price tends to fall, and conversely, if the Fed lowers rates, the index's price tends to rise. This relationship exists because when the Fed issues new bonds at higher interest rates, the price of existing bonds in the index decreases. This occurs because the index holds bonds with lower yields, causing their prices to adjust lower to maintain competitive yields compared to the new bonds, thus increasing the index's dividend yield. I don't expect the Fed to increase interest rates anytime soon. Currently, rates are at their highest levels, and inflation is relatively stable. The economy is slowing down because of the burden of high debt, which is hurting many businesses and banks and discouraging investors from investing in the economy. Therefore, there's no immediate need for rate hikes, which reduces the risk associated with this index. Furthermore, lowering rates could help stimulate the country's economy. Lower rates would make borrowing cheaper for businesses, leading to the creation of new jobs and increased consumer spending, which would boost the overall economy. This economic activity would also increase tax revenues for the government. However, it's important to proceed cautiously because overly rapid rate cuts could potentially lead to renewed inflation, which would negatively affect the country's residents. And the final fourth reason why I buy this index is that its dividend payout is gradually increasing. This index has 43% of its bonds maturing in 1 to 5 years and 36% in 5 to 10 years. This means that as these bonds mature, the fund will have funds available to purchase new bonds at higher interest rates, thereby increasing the dividend payout of this index. This trend is already evident. Previously, when interest rates were nearly 0% from 2020 to 2022, the index was required to invest in bonds that generated minimal returns. Now, more than 4 years have passed since 2020, and these bonds are approaching maturity. The index will have the opportunity to replace these bonds, which previously yielded 3% before 2020 and 0% after 2020, with new bonds yielding approximately 5% annually. This anticipated change will contribute to a higher dividend payout for this index. Today, you can already see this theory becoming reality. In 2020, the index paid 13 cents per share per month, whereas current payments are at 21 cents per share per month and continue to grow. It's worth noting that when the index paid 13 cents, it was priced at $88, reflecting the impact of the low Fed rates during that period. Therefore, summarizing this index fund, we can say that it is primarily one of the safest assets. Second, it pays a dividend of about 3.62% per annum, and that yield is growing and will soon catch up with dividend aristocrat Coca-Cola. Third, this index has the potential to go to at least $77 to $79 per share because if you take 2018, for example, when the Fed rate was around 3% and the index was paying around 19 cents, the price was around 79. So I expect the Fed to be forced to cut interest rates over the next 2 years, and I've talked about this many times in my past videos. I don't expect it to be quick. In my view, the right decision is to lower the interest rate a little bit to get the inflation data, and then make the next decisions about whether to leave it at those levels or lower it further, and I think they will understand what the level should be to balance inflation and economic growth. I expect the price of this index to be at least $80 per share due to lower interest rate and increasing dividend yield, and I expect to see that in the next 2 years. That means over these 2 years, I expect to receive about 3.6% in annual dividends, which are increasing. This would result in a total of 7.5% return on investment over the 2-year period. Additionally, there is a growth potential of at least 13%. When you add it all up, it suggests a potential profit of around 20% in the next 2 years. It's worth noting that the average return of a highly risky asset like the stock market is 10% per year. This means investing in stocks could potentially lead to losses of over 50% in the first year, as seen in examples like 2008 and 2020. By taking such risks, investors hope to achieve a 10% average return over the long term. However, investing in this index offers an almost risk-free alternative that can provide similar returns. That's why I currently have 93% of my portfolio invested here. If you're planning to invest for at least 5 years, stocks may still be a better option. But if, like me, you expect the stock market to decline, then this index is a great alternative for navigating uncertain times. Don't forget to subscribe so you don't miss my upcoming videos.